Welcome to our video, The Basics of Trading Using Supply and Demand. Supply and demand is the most basic principle in economics, but it seems to be ignored by most traders. The laws of supply and demand state that if supply is greater than demand, prices will go down, and if demand is greater than supply, prices will go up. This is what drives price movements in any market. Markets will trade sideways if supply and demand are in balance. It doesn't matter what any technical indicators are telling us. If supply is greater than demand, the price will go down, and if the demand is greater than supply, price will go up. It's that simple. We plot these areas of supply and demand as zones on our chart. We can define the zones by looking at previous price action. On this chart, the blue dots indicate a change in price direction. Every time price changes direction, there is an imbalance of supply and demand. The key is being able to determine the likelihood of the imbalance still being there when price returns to this point. This is where most traders have frustration when trying to apply supply and demand principles to their trading. I promise you, if you learn how to properly draw supply and demand zones, you'll never use technical indicators again. In this chart, we see an example of price trading sideways for 3 days and then making a rapid drop down. As you can see, when price returned back to the zone, price retraced, giving us a nice trade. On this chart, we have a pivot candle and then price breaking away from that area rapidly. Again, you see when price returns back to that zone, price reverses again for a nice trade. Anytime price is moving rapidly and then pauses and then moves rapidly again in the same direction, the area that there was a pause is likely to provide major support or resistance. These areas are identified on the chart like in the example here, or it can be identified by a small doji candle. Typically, you want this price action to occur roughly halfway down the impulse wave. You can see that when price returned to this area, again price retraced, providing us with a nice trade. In the previous examples, we were looking at supply zones, so we're looking for short trades. The principles are the same for demand zones and long trades. There are 3 basic things that we look at to determine the strength of a zone. The first thing we look at is how fast and how far price moved away from the starting point of the zone. We would then look and see if the impulse wave that created the zone broke through previous supply or demand. Next, we want to make sure that this zone is a fresh zone. In other words, we do not want this to be a retrace from a previous supply or demand zone. On this chart, we have 4 supply and demand zones plotted. Zone A and C are supply zones, and zones B and D are demand zones. All of these zones have extreme moves, which tell us there is a strong imbalance between supply and demand at these price levels. Zones A, B, and D also broke through previous supply or demand, which adds more credibility to our zone. Notice that zone C did not break through the previous demand, and it also did not hold when price returned to that zone. You may be wondering where zone A broke through demand. We will discuss this next, but when price breaks through a supply zone, that supply zone now becomes a demand zone. The same holds true when price breaks through a demand zone. That demand zone is now a supply zone. The pivot high that you see before zone B was a supply zone that became a demand zone when price broke through on the way up to zone A. As I was saying, when a supply zone is penetrated, it becomes a demand zone, and when a demand zone is penetrated, it becomes a supply zone. Here is an example of price breaking through a demand zone, turning that demand zone into a supply zone. As you can see, when price moved back up to that zone, it retraced, giving us a nice trade. In this chart, we have an example of a supply zone where price broke through and then turned it into a demand zone. Again, you can see that when price came back to the demand zone, price reversed and continued up. There are also other ways of identifying areas of strong supply and demand. The first is by using volume profile charts. The yellow lines on the chart on the left show us the price points where most of the trades have executed. I refer to these as peaks. These price points are likely to provide areas of support and resistance. The reason is supply and demand is imbalanced at these levels. These levels are typically used for targets to exit a trade, but when price moves rapidly away from one of these areas, we plot that area as a strong zone, especially if price breaks through previous supply or demand like it did on this chart. The chart on the right shows an example of what I call a valley. In a valley, there's very little trading action. I would draw a line at the top and the bottom of these valleys, and these lines provide support and resistance. This valley was caused by a gap down at the open, but sometimes you see these valleys during intraday trading. The 2 dark black lines represent where the gap started and where the gap ended. When the valley is caused by a gap, I use these points instead of the outline of the valley. The second way of identifying areas of supply and demand is by drawing trend lines connecting areas that price moved away from rapidly. These lines are considered supply and demand lines. We look for a breakout of these lines. We typically will look for a close that breaks through this line. In other words, if price breaks through the line but doesn't close past the line, we will pass on that trade. This includes our basic video of trading using supply and demand. I would encourage you to watch the other videos that we have that cover this information in more detail.